Welcome back, money movers and financial explorers, to Money Talks, your guide to the Canadian Securities. I'm your host, Rita, and I'm super excited to unpack another essential piece of the investment puzzle with my brilliant co-pilot and financial professional, Alexis Goldbloom. Hey, Alexis, how's your week been treating you?
Hey Rita, it's been a busy one as usual, but always a good week when I get to chat about something fascinating like investing.
Love to hear it. So, Alexis, my brain has been swimming in shares this week, and I've got to say, it's like pulling back the curtain on who really owns a company. Forget just numbers on a screen. This is about becoming a part of something, which is pretty cool. Before we jump in, a quick favor from all of you listening. If you love what you hear and you're learning something new about Canadian investing, please hit that subscribe button and share this episode with a friend. We want to reach as many Canadians as possible to help them feel more confident about their money. All right, Alexis, let's get into it. When most people think about the stock market, they're usually thinking about common shares. What exactly are common shares and what does it mean to own them?
That's right, Rita. Common shares are arguably the most well-known type of investment, and for good reason. When you buy common shares, you become a literal owner of that company. You're not lending them money like with a bond, you're buying a piece of the business. This is why common share capital is sometimes called venture capital or risk capital. If the company prospers, you benefit from its growth and potential profits. But on the flip side, if the business fails, you could lose your entire investment.
So it's about being an owner. What are some of the key characteristics or rights that come with owning common shares?
The biggest and most fundamental right for common shareholders is voting privileges. Typically, it's one vote per share, and those votes allow you to elect the board of directors and vote on major company decisions. It's how shareholders exercise their control. Another key characteristic is how they rank in terms of claims if a company goes bankrupt. Unfortunately, common shareholders are last in line. All of the creditors, like banks and bondholders, get paid first, then preferred shareholders, and then common shareholders get what's left, if anything. And regarding income, common share dividends are entirely at the discretion of the company's board of directors. There's no guarantee they'll pay them or that they'll continue to pay them.
So the trade-off for that potential for growth is definitely higher risk and less certainty on payouts. But what are the big benefits that draw so many investors to common shares?
Absolutely. The main draw for most investors is the potential for capital appreciation. This is when the value of your shares increases over time. If a company grows, becomes more profitable, and investors are excited about its future, its stock price can really climb. Plus, if the company pays dividends, those can provide a nice stream of income, and in Canada, dividend income and capital gains from Canadian companies get favorable tax treatment. Common shares are also very marketable, generally easy to buy and sell on exchanges like the TSX.
Okay, so that's a pretty good picture of common shares. Now, sometimes you hear companies talk about stock splits or consolidations. What are these and how do they affect shareholders?
These are corporate actions that change the number of shares outstanding, but not your total dollar value of ownership. Think of a stock split like getting change for a $20 bill. If you have a $20 bill and you split it into two $10 bills, you still have $20, just in smaller denominations. A company might do a 2-for-1 stock split if its stock price gets very high, making it seem less affordable for individual investors. So if you owned 100 shares at 100 each, 10,000, after a 2-for-1 split, you'd own 200 shares at 50 each, still $10,000.
So it's like rearranging the deck chairs. The ship's value doesn't change, just the number of shares and their per share price. Let's pause here for a moment and ask our listeners, have you ever owned a stock that underwent a split or consolidation? How did it feel? Let us know on social media using #MoneyTalksPodcast. And if you're finding this helpful, remember to subscribe and share. Your support helps us keep bringing you these deep dives into the Canadian markets. Now, Alexis, moving from common shares, let's talk about their often misunderstood cousins, preferred shares. They feel like a bit of a hybrid, don't they?
They really do. Preferred shares sit in an interesting spot. They're often seen as a hybrid between common shares and bonds. While they are still a form of equity, meaning you're an owner, they behave a lot like fixed income securities. The main defining feature is that preferred shareholders are usually entitled to a regular, fixed dividend payment. Unlike common shares, where dividends are discretionary and can fluctuate wildly, preferred shares promise a set payment, making them attractive for income.
So they're preferred because they get a consistent dividend? What else makes them special compared to common shares?
Yes, they have preference as to dividends over common shares. This means the company must pay preferred share dividends before any dividends can be paid to common shareholders. And if the company skips a preferred dividend, a common feature called cumulative preferred shares means those missed payments, called arrears, accumulate and must be paid before common shareholders get anything. Most Canadian preferred shares, however, are actually non-cumulative, meaning if a dividend is skipped, it's gone forever. They also have preference as to assets in case of bankruptcy. They rank ahead of common shareholders for claims on assets, but importantly, they still rank behind all creditors and bondholders. So, they're safer than common shares, but not as safe as bonds. And another key difference, preferred shares generally have no voting privileges. That's a big trade-off for the more stable income.
So, it's an income-focused investor's dream, but with some quirks. What are some of the different flavors of preferred shares out there?
The Canadian preferred share market is quite dynamic, offering several types. The most basic are fixed-rate perpetual preferred shares, which pay a fixed dividend indefinitely and have no maturity date. However, almost all of these are callable, meaning the issuer can buy them back at a set price and date. This is a risk for investors because if interest rates fall, the company might call your high-dividend preferred shares back. Then you have floating-rate preferred shares, where the dividend adjusts or floats based on a benchmark like the Canadian Bank Prime Rate or T-bill yields plus a spread. These are less sensitive to interest rate risk because their payments adjust. A very common type in Canada are fixed reset preferred shares, particularly rate reset preferred shares. They start with a fixed dividend for an initial period, usually 5 years. Then, every 5 years, the dividend rate resets based on the current 5-year Government of Canada bond yield plus a fixed spread. At each reset date, the issuer usually has the option to call the shares, or the investor might have the option to convert them to a floating rate preferred share. They offer predictability for a period, then adjust to market conditions.
Fascinating how they adapt. So, why do companies issue preferred shares, even though the dividends aren't tax-deductible for them like bond interest is?
Companies opt for preferred shares when debt markets aren't favorable. Perhaps their existing assets are heavily mortgaged, or they have too much debt already. Preferred shares also avoid diluting the ownership of common shareholders, which a new common share issue would do. It's often a strategic compromise to raise capital without taking on more debt or giving up too much control. And for investors, they're attractive for their yields, which are generally higher than bonds for similar credit quality. The preferential tax treatment of dividends in Canada also makes them very appealing. Plus, they offer portfolio diversification because their returns often have a relatively low correlation to both common shares and bonds.
So, they can be a great addition to a diversified portfolio, but they're not without risks, right?
Definitely not. Like bonds, they carry interest rate risk, especially fixed-rate preferreds. They also have credit risk. If the issuer's financial health declines, the preferred share price will suffer. Then there's call risk, where the company calls your shares when rates are low, and extension risk, where they don't call them if rates are high, forcing you to hold them longer than desired at a lower market price. Finally, the Canadian preferred share market can have liquidity risk, meaning it might be harder to sell large blocks of certain preferreds quickly without impacting the price.
That's a comprehensive look. And for our Canadian listeners looking to broaden their investment horizons, we should briefly mention Canadian depository receipts. What are these, Alexis?
CADs are a fantastic innovation. They allow Canadians to invest in popular U.S. and global companies, but with a unique twist. They trade on the Cboe Canada Exchange in Canadian dollars and have a built-in currency hedge. So you get exposure to giants like Apple or Amazon in Canadian dollars, and the exchange rate fluctuations are virtually eliminated. They also offer fractional ownership of high-priced stocks.
That's a great way to access global companies without the currency headaches. Finally, we can't talk about shares without quickly mentioning stock indexes. These are vital tools, right?
Absolutely. Stock indexes are our barometers for market performance. In Canada, the most well-known are the S&P/TSX Composite Index, which represents the broad Canadian market, and the S&P/TSX 60 Index, which tracks the 60 largest companies on the TSX. They help investors and portfolio managers gauge performance and create index funds.
Incredible episode, Alexis. We've covered so much, from becoming an owner with common shares to navigating the hybrid world of preferred shares, and even touching on Canadian innovation with CDRs and our market benchmarks. This really empowers our listeners to think beyond just stocks and understand the different ownership stakes they can take in companies. If this episode piqued your interest in building a diversified Canadian portfolio, remember to subscribe to Money Talks wherever you listen to podcasts, and share this episode with anyone looking to understand the Canadian securities market better. Thank you again, Alexis, for sharing your incredible knowledge.
My pleasure, Rita. It's always a fun chat.
And thank you, our incredible listeners, for joining us on Money Talks, your guide to the Canadian securities. We'll be back next time with another essential topic to help you invest smarter. Until then, keep those financial minds curious.